Still with us to discuss some strategy advice is Philip Manduca. He's head of investment at the ECU Group. Philip, as we left off talking with Edward there about these the financials in the United States, you know, we're going to be getting sort of criteria for the stress test later on this week, and then the results on May 4th, I believe. Do you think there's a danger that when we get these results for the stress test that they may not actually portray what is actually going on with the U.S. financials? Because the concern is that the U.S. government does not want anyone to be able to distinguish between the good banks or the healthier banks and the not so healthy banks, because that would end up causing another run and another big problem like we had back in September again.
Of course you're right, Maura. There's a politically driven stress test. It's going to be politically announced, and it's not going to cause any political problems. It is definitely going to try to brush over as much as it can, and I do expect that the equity market to try to rally into and out of the stress test results, which will start being leaked as early as this weekend. It was very interesting to hear what Edward was saying in the programme just a little bit earlier. I disagreed with him about just about everything other than the fact that he talked about the banks being in bad shape going forward. He mentioned one thing that needed to be picked up on, which was that growth's no longer falling. And that's, of course, wrong. Everybody knows who's been skiing that the slope of the descent is steepest at the top. You wouldn't expect the rate of descent to continue to be as steep going on, and it won't be. But that doesn't mean that you're not descending, and growth is continuing to weaken. Just because it's not weakening, Becky, at 5% rather than 3% doesn't mean you're not getting deterioration. We are in everything, and this is the problem. They are mitigating the rate of descent. They are not reversing that descent into an ascent. And how can you be bullish of equities other than on a speculative basis on PE multiples or anything else going forward? You can't. That doesn't mean, however, that we're not going to get a rally, because I've always said on this programme and others that 98% of equity investors are long only. Most of them are benchmarked. Most of them wake up in the morning needing and wanting to believe that the story is going to get better. And I do believe that that's how they're going to look at this stress test story that you're referring to, Maura. I do therefore think that with everybody believing that this is a bear market rally, that the bear market rally will extend further than makes the bears comfortable. And that means that from the S&P point of view, we will probably get a 9 handle rather than an 8 handle before this all comes to an end and economic reality dawns on everybody.
So, Philip, this is Mike Uckman in the States. If you're not all that bullish on the economy and on equities, let's talk gold for a moment. I think you see it trading even lower, down to 750 to 850 range. But I think it's interesting that there was a major money manager quoted in this week's Barron's who thinks gold is going to $1,500 an ounce over the next year or two. So please explain your relatively bearish position on gold right now.
Well, don't get me wrong, Mike, and don't ever quote me as being bearish on gold, because I'm not. And I know it won't be for quite some time to come. Indeed, on this programme, I forecast that gold will go beyond 2,000 before 2010 is out. And I still believe that very much. What I do think is happening here is that as sentiment is trying to improve, albeit on an artificial basis, as risk on is trying to assert itself as a trade in markets, gold is getting slightly left behind. And, of course, around the gold market, you've got this huge fear that the IMF is going to raise money via gold sales. And that, of course, is keeping a lid on the gold price. I do, therefore, think that if risk on and greed and need are going to be the dominant emotions over the course of the next 2 or 3 months, which is my current best view, then I do think that there's a risk that gold can get some speculative liquidation in what is a crowded trade back to the 750 to 850 level. But I wouldn't be short. I would see that as a buying opportunity. Gold, to me, in a macro sense, is a one-way bet. It doesn't help that my risk is $50 to $100 from here. I understand that. But it is an accumulation trade, and you will, in my opinion, see gold well above 1,500 before the end of next year, based on risks of inflation, because it's the only way we're going to get out of the debt problem, currency debasement and devaluation, because it's the only way we're going to get out of the debt problem, and, of course, the potential for a massive debt bust, which will be another way to get out of this current debt problem.
Philip, pretty brave predictions. Do stay with us and expand on those in a few moments' time. Philip Manduca, Head of Investments at the ECU Group.